Hey, Jason here. Today I want to introduce our new series to Uncommon Investing Terms. Uncommon Investing Terms, our new series. In this series, we're going to be talking about, of course, uncommon investing terms, why they're important for you, what they mean, why they're important for the investment analysis, how you can gain a huge advantage in some cases knowing what these mean, how you can avoid potential red flags by knowing what these mean and what these show for companies. You'll learn all that and more in this brand new series. I hope you enjoyed. Let us know in the comments below if you. Hey, Jason here. In today's episode of Uncommon Investing Terms, we are going to talk about total enterprise value. Before I tell you that though, or before we go over that, I need to tell you that you can get this series as a podcast anywhere in the world for free on all major podcasting platforms: Anchor, iTunes, Stitcher, SoundCloud, Spotify, and more. You can get this and our previous episodes in this series as a podcast anywhere in the world for free. Okay, so far in this series, we've covered things like investment float, net operating loss carryforwards, accumulated deficit, retained earnings, impairments, write-downs, and the difference between impairments and write-downs. And the links for all those will be above or below this video. What we're talking about today is total enterprise value. Frankly, this is one of the most important metrics I calculate. So this video is going to be longer than most of the other videos, and it's also going to be longer because it's going to be more in depth as well, because there's a lot of nuances when it comes to this. I have an entire total enterprise value training course that I produced and is available below this video. If you're on the blog, that link to that will be below this video. This is the number one thing I get questions about by students, is total enterprise value. Students of my masterclass, of the value investing masterclass, and the one-on-one coaching program. This is the number one question I get. So this video is going to be longer because of how important it is, and also because of the various nuances involved in this calculation as well. Okay, so we're not going to talk about enterprise value. I've talked about enterprise value quite a bit elsewhere on the blog, and I'll try to find those links as well and link those below this for reference to this. So I'm not going to talk about enterprise value at all, other than we're going to calculate enterprise value, but we're going to add some more stuff to it. Total enterprise value is the estimated value of the entire business when considering all of its financial assets and liabilities. So enterprise value is the estimated value of the business when considering cash, debt, market cap, things like that. Total enterprise value takes it another step further, because it also includes, as you can see from the calculation here, market cap, all debt equivalents, including capitalized value of operating leases. We'll talk about that. Unfunded pensions, cash and cash equivalents, short-term investments, long-term investments, and net deferred tax assets. The reason we are doing this is because as a deep, long-term, conservative value investor, I think of owning stock as owning part of a business. And to me, that's how you should think about it as a long-term value investor, because then it puts you in the mindset of, if I'm owning part of this business, again, not the stock, the business, if I'm owning part of this business, what are the total assets, liabilities, and other things I need to know about if I were to buy the entire company? This puts an estimated value on the entire company, including all of the things that you see on the screen right here. And this, what we're looking at here is the value investing journey valuation and profitability metric templates. You can download those for free. I'll link that below. So you'll get this and 4 other free gifts by signing up for free. Just putting your name and email address, you can get this template or these templates and 4 other free gifts just by signing up for free below. Okay, so having said all of that, I'm going to bring in my screen here. So I copied and pasted it over because we're going to do the calculation live here, and I'm going to show you what you need for it to be live. You need to go to Morningstar, and let's just pick a company. Let's pick a company that might be interesting, should be interesting from this perspective. Let's go try Disney. So I'm showing the exact process I use every time I calculate this number, showing you exactly what you need. Okay, so blah, 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 blah. You need this. You need the market cap. You need balance sheet. And you need for the, this is all you need for the enterprise value. For this, one step further, you need the company's annual report as well. Not the quarterly report, the annual report. Has to be the annual report, because a lot of this stuff that we're going to calculate is not talked about in the quarterly reports. It's only talked about in the annual reports. Okay, so this was just released. This is not the full annual report. So we need to go back, because you need the full annual report, not just the kind of summation, which was what that was. You need the full annual report. Okay, 142 pages. That's more like it. Okay, so we'll get rid of that for now. Bring back up our calculation, and I'm going to put in the other screen, which you probably will not be able to see, I don't think. I'll bring this over to my other screen just to save time. Back here. In my other screen, I brought over the Morningstar pages just so we can calculate this a little bit faster. And I always make note of this. So that I can come back at any time and not have to wonder if the numbers are in billions, millions, or whatever. Okay, so market cap 252.1. That's going to annoy me. So plus all debt equivalent, and I should have brought the balance sheet over as well, but I'll just bring that up another tab. Okay, and on Morningstar, I want to bring this back over real quick. So on both the short-term debt and the long-term debt, it said total current debt and capital leases. That's new on Morningstar. If there are capital leases, they will be in this section. And you need to add the total number here, because you need to add current debt and capital leases to this part of the calculation. Anything that essentially the company pays interest on, the line of credit, if that was in here, you would put on that, and that would be in the short-term debt. Usually, same thing here. Just a notification. Again, there's going to be a lot of nuances, so we're going to stop at some time to go over that. Okay. Plus, okay, so this is, for the most part, this is enterprise value right here. So this is where we're going to take a step further, including the capitalized value of operating leases. So operating leases, you need to go to the annual report to find. These sometimes come over different terms. And usually if they do have some there in a chart that looks kind of like this. Okay, borrowings, that's debt. So we wouldn't talk about that. We wouldn't add that here. Capital lease obligations should be in that calculation on Morningstar. Okay, so this is what you want. You want the final kind of numbers here. Okay, the reason you need to go through this is to figure out if you should add these amounts into this calculation. In my opinion, you should, because they are contractually obligated to pay for these TV programming rights. So it's similar to operating leases. Operating leases are things typically like leases on office buildings or something like that. So you have to pay them to essentially continue operating your business. The TV contracts are the same thing. To continue their business operations in TV, they have to pay these or they lose the rights to them. So in my opinion, these should be included in the calculation. But let's start with operating leases first. So you only use the most recent number, or the first number here. Pretty much always use this number. Why do you always use this number? Because it's likely the most accurate. Over time, you see these numbers get smaller because they're not as accurate and they're not based on their contracts. They may be able to get out of contracts, whatever. The reason you do this number is because it's likely the most accurate representation of what you're going to have to use over time. You also multiply this number by 7. I pretty much do all the time multiply this number by 7. The reason you do that by 7 is because typically operating leases last for 5 to 10 years. So I use the median number, which is 7. Obviously, if it says outright these contracts are for 3 years, you use 3 years. If it says it's for 10 years, these contracts, you use it for 10 years. And you multiply by that same number. For this, I don't see anything talking about specific dates. So we are going to use 982 times 7. So that's 6.9 billion plus, oops, 982 times 7. And the reason I do this, and where I list everything out, even if I do this myself, is again, so I don't have to guess at what these numbers are when I go back and want to look at them. Equals 6.9. Oops. Plus and this is different because most companies, if they have operating leases, they only have operating leases. They don't have things like broadcast programming. So I'm glad this is something different. So 11.5 7, so 80.5. Oops, see, there's my family. Oop, forgot the number. What was the number? 11.5. Okay. Unfunded pensions are next. I'm going to bring this back over here. It's already saw pension. So typically everything up to this point is for the most part straightforward. Pensions is, again, this is overall total enterprise values where I get the most questions from my students. Pensions, when it comes to pensions, retirement plans, frankly, this is the number one area that I get questions about. The reason is because there will be different numbers in here, and you need to find the right numbers. What do you mean by the right numbers? I'm going to try to show you because they are going to, here we go. So, okay, so we're going to go through this. This looks like it's the right area for once. So you want the unfunded part. So here are the total obligations right here. There's the fair value estimate of their assets in their pension / retirement plans. So you want the unfunded part. So 3.6. And you'd also include in this post-retirement medical plans as well, because that's, again, a cost they will have to bear in time. So I'm going to write that, and I'm going to bring that over here. Okay, and this is actually better put together than most pension plans. This is pretty straightforward. Usually there's like 3 different sections of what's in the plan, what's funded, what's not funded, and typically they don't even say the word unfunded like they did here. Typically it's how is it worded? Typically you'll see things like unfunded, obviously, which is actually pretty rare. Typically you'll see things like underfunded, or they won't even say funding at all, or they won't break out the obligations. They'll say the obligations, but they won't say what portion is unfunded. So there's a lot of different things to look out for here, and you need to try. And again, this, we got lucky here. This one is actually says, there we go. Oops. Unfunded or underfunded status. Most of the time it will be a liability, or it will not say underfunded or unfunded most of the time. Again, we got lucky here. So just be cognizant of this. You need to try to figure out, if it is confusing, you need to try to figure out the unfunded part or the underfunded part of the obligations. Again, I talk about that more in the course. that I built for students for this. So if you have more specific questions on some of the terms you'll see, make sure to go look at that and get that program. Okay, so what's next? Minus cash. Minus cash. So 5.4. Minus short-term investments. Again, these will be on the balance sheet. I'm just scanning the balance sheet right here. I'll bring it back over here for you so you can see. Okay, so cash, obviously at the top. Investments. Equity investments, I don't see any short-term. What are the short-term? I don't see, I didn't think I saw, and I just wanted to make sure but I don't see any short-term. So this is how I would word this. Minus. Okay, now we need to go back to the annual report and look at deferred tax assets. Again, some of these are things like net operating loss carryforwards. And we want the note on these, the footnote. So usually in here in the income tax section, okay, so here's what we want, and there's more of what we want, and there's a lot of information here. So I'm scanning all this to make sure we don't need any of this down here, because sometimes, usually after this entire section up here, there's talk down here about the final number of net operating loss carryforwards if they have any. So I usually like to scan down here to make sure. Okay. So they do have some NOLs. Okay, so what we need down here. Oh, that's because of that. Okay, so what we need here is okay, so here's where they talk about the NOLs. Again, they don't call them net operating loss carryforwards here, so you need to be wary of what they are. Okay, but these is where they talk about their final amount of NOLs. Because they talk about reducing taxes. If you see talk about reducing our income tax expense and effective tax rate, those are NOLs. What number we need here, I believe, is this number. Again, there's a lot of nuance in this, so you have to kind of try to figure out and parse the information. At first, you would probably think it was this, because that is the kind of total down here after adding and subtracting everything. I would add this number right here, because this talks about the final year, and then especially after reading this, obviously it can't be negative up here if they have $2.4 billion in NOLs. So just logically, it doesn't make sense because obviously net deferred tax liability, that would be zero. Oops. Didn't like me to do that. So I would say it was this number. Again, they, just like with pensions, they usually won't come out and say it. But I would subtract this number. And again, anytime you have a question about anything when it comes to this, calculating anything like this, owner's earnings, investment float, total enterprise value, if you're on the side of conservatism, you should be fine. The reason this is important, net, because if this is zero, let's say this is a liability and they have negative amount at what I just showed you, I would just do subtract zero, because again, I want to be conservative in my estimates. So I don't want to add a huge number here, because again, if it was a negative or positive. So this is -3, okay, equals, we're done with the calculation. Okay, so what this means, if this number is higher, it means the company has significant debt that it doesn't show up when you're just looking at market cap. And again, like when I talked about enterprise value, why I don't like using just market cap is because it doesn't include cash and debt, which again, 99.9% of companies have one or both of those in the world. So to me, it doesn't make sense to measure the entire value of the business just on the share value. So another thing this also means, the inverse of this is also true. So if this was, let's say, 200 billion, it means the company has a lot of cash in relation to debt. Another thing this can show is that if this is higher, is that the company as it currently stands is overvalued, at least based on this one metric. Because again, this does not include debt. When you include debt and their other obligations, it's this number. If this again was 200 billion, this is a sign the company may be undervalued. This being lower than TEV also means there's less margin of safety, because again, the more debt the company has in relation to cash, the less margin of safety there is. In this case, frankly, it doesn't matter, because Disney produces so much cash that their debt load, frankly, it doesn't really matter that much unless their businesses just completely go away. They can pay off this debt with cash, and or issuing more debt at cheaper prices. So this is a big deal for smaller companies that I typically look at. For bigger companies that produce a ton of cash, this typically isn't a massive deal. And it probably doesn't even mean that the Disney is overvalued right now either, which it may be. But if this was a smaller company, for example, this would be a significant potential overvaluation. Again, Disney produces so much cash and has such huge competitive advantages that frankly it doesn't matter right now. But those are some of the things I look for when I use this number. So this again was longer than most videos. Let's see what time we're at. Almost 30 minutes. So again, this is still only scratching the surface of this number. This number varies widely by industry, by company, and depending on how many pensions, retirement benefits, operating leases, different kinds of numbers you add to this calculation, this number varies widely by industry, by company. So it will literally be different, not just because the companies are different, but you'll learn something new every time you do it, because there will be something like this, like broadcasting rights capitalizes. I've never used that before in a TEV calculation. And frankly, you don't see it very often in smaller companies. You see operating leases quite a bit, but you don't see anything like this that you normally have to add. Same thing with pension plans. Typically, most smaller companies don't have pension plans anymore in the United States or even around the world. So typically, you don't add those. So this was a good case study. I hope this helps. If you have any questions, let me know in the comments below. If you want to check out and learn more about total enterprise value and why this can give you a huge advantage over other investors, and it can, because again, most people won't take the time to do this work. So this number can either show you potential red flags to watch out for. For example, if the company couldn't facilitate and pay off all this debt and these pensions, this would be a major red flag, obviously, because they have an enormous amount of those. It can also show you potentially huge hidden assets, like net deferred tax assets as well, or potentially huge undervaluation or overvaluation. So this number is one of the most important things I calculate. Can give you a huge advantage over other investors. Yes, this took about 30 minutes to do, but it'll save you an enormous amount of time because it shows you so much information about the company in 30 minutes. Again, yes, 30 minutes is a long time for one calculation, but you get a ton of usage out of this. So I look at it as positively leveraging my time because it shows you multiple different things in one calculation. So I hope you use this. Again, don't be intimidated. If you have any questions, let me know. Social media, whatever, email, whatever. If you want to learn more about this in depth, make sure to check out our Total Enterprise Value video training course where I go over different scenarios with students and different questions they've asked me that you might come up against as well. And make sure to check out other videos in this series. This entire series is built to teach you uncommon terms so you can gain a huge advantage over other investors. So hope you check out the other videos as well. Until next time, have a great day. Talk soon. Bye.